of Barjeel Geojit Financial Services. This is a webinar that we have been doing every Saturday for the last 6 weeks. It's been very heartening to note that the number of participants have largely benefited with what we have been doing. That's the feedback that we are getting from many people. And I thank you all for logging in once again to this webinar. I'm also take this opportunity to welcome our clients from our joint venture in Muscat, QBG Geojit, who have been there with us for the last 3 weeks in this webinar. And as usual, we have an interesting talk lined up for you today. The market over the weeks when we have been discussing, every week has been a different sort of a scenario and a setup that we have been witnessing from the beginning of the COVID-19 situation that happened sometime in March. Last week was another volatile week, but last week was also a very important in the sense that it was the week that the government began the announcement of its 20 lakh crore stimulus package, of which three such announcements are complete, and we expect 2 more announcements, that is today and tomorrow. And we are also expecting the announcement of how the lockdown is going to pan out, the opening of the lockout is going to pan out in the country starting next week, to what extent and in what time frame. So we are lined up with a series of announcements, and all this is going to have its impact on the markets. Before I proceed to introduce our speaker for the day, let me inform you that you have a Q&A option that is available on your screens, which you can use to ask questions. Some of you can also use the chat mode. So after the end of the session, I will consolidate all these questions and address a few of them to our speaker of the day. We've also introduced a poll feature. So before we go for the vote of thanks, we will pop up 2 small questions where we would like to have your feedback in terms of how you found these webinars and in what frequency would we like to have them. Because next week, as you know, is the week of Ramadan. So we may not have a webinar unless there is a need or a situation that arises. But we will continue this series as we proceed in the next few weeks and months. On this score, let me begin by introducing and welcoming the speaker of the day, Mr. Rahul Singh, who is the Chief Investment Officer, Equities of Tata Asset Management Ltd. Mr. Rahul Singh has over 24 years of experience and joined Tata Asset Management in October 2018 as its CIO. In his previous role, Mr. Rahul was the managing partner with Ampersand Capital Investment Advisors LLP. Prior to that, he has worked with many reputed financial institutions like Standard Chartered Securities and Citi Global Markets India as head of equity research. Mr. Rahul is a Bachelor of Technology in Mechanical Engineering and an alumnus of IIM Lucknow, where he pursued his Master's in Business Administration in Finance and Financial Management Services. Thank you, Mr. Rahul Singh, for accepting and agreeing to address our clients today. And over to you, Mr. Rahul. Mr. Rahul will have a small presentation, and he will start his talk. Mr. Rahul.
Thank you, Mr. Krishnan, and welcome everyone, and thank you for taking time out for this presentation and talk. And I hope all of you can, Mr. Krishnan, you can see the presentation?
Yes, I can. Can you put it on slide? Can you expand the slides? Yeah.
Yes. So what I thought I will do is talk about 3 different areas which I wanted to focus on. First is obviously where do we see the bottom in the Indian market? I think that's the most obvious question which a lot of you might have, given that markets have bounced back and the economy has not yet bounced back. So I'll take you through some of my thoughts on valuation, because ultimately equity markets follows profits, and we will talk about that. Secondly, we'll talk about what we have done in our portfolios, how we have changed our portfolios. I think that is very important. And lastly, I'll talk about what do we make of these fiscal packages, what more to expect, and then in the end talk about some of our funds, what kind of funds we think make sense for investors, what kind of equity allocation makes sense for investors, and so on. and then we'll open it to Q&A. So let me start the presentation by quoting Viswanathan Anand, who's all of you must would know, the famous chess player and 5-time world champion from India. So he was, he used to get quite irritated by this question which used to be asked for any chess player, that how many forward moves do you think? And he said that if it's a highway, then you can look far ahead. But if it's a dense forest, you have to take one step at a time, because after every step, there are 3 or 4 options where you can go. So there's no point looking far ahead. And if you look too far ahead, chances of making a mistake are much higher. And I think it's amazing for him to say that, because as a chess player, you would always think that you are always looking 6, 7 steps ahead. And the current situation in the market, I would equate a little bit to that, because, imagine COVID as an unpredictable chess opponent which is also making moves, and we don't know the moves. You don't know the kind of trajectory which the virus is going to take. All you're trying to do is to have the right degree of offense and defense in your game. And I'll come to how that offense and defense come in our portfolios, and that is what you need to do in your portfolios. It's as simple as that. You need to manage risk. At the same time, you need to have little bit of offense in your portfolio, so that in equities you're not totally defensive and you're trying to also generate returns. But before I come to that, let me first, so this is the agenda. I will talk about earnings outlook and valuation, which will give you a sense of the bottom or where do I see the support in valuations. As I said, I'll talk about structural shifts, China plus one, what kind of opportunity, because there are silver linings for this in India. And let us not forget that, and government is already making moves to that. Then some advantages on low crude and fiscal package, as I said, I'll come to that. So let's start with what kind of earnings we are looking at. And this is an interesting chart I picked up from Kotak Research. They are the research house which publishes these estimates for all profits for Indian companies. Now, it's interesting if you focus on the black line, which is the combined profitability of Nifty companies, how they have behaved in the last 4 or 5 months. So if you look at, in fact, last 3 months, it has come down from 670 to 564. So you've already seen about 20% cut in the earnings or profits of the corporates for the current fiscal year, which is April 2020 to March 2021. For the next fiscal year, which is fiscal year 2022, which is April 21 to March 22, the cuts are more moderate at about 10%. But I think you will probably see, because the lockdowns are getting extended, I think you will probably see more earning cuts or more profit reductions in the current fiscal year. But unlikely that you will see significant amount of cut in 2022, which is next fiscal year. And the reason for that is that, this is how I summarize that chess game, which I was talking about earlier. This is a chess game. There are 2 options in the first level, which is we get over the virus, and the second option is we live with the virus. As of now, I think it looks like we will have to live with the virus, which means we'll have staggered lockdown removal, and there could be second waves, like it's happened in China and South Korea to some extent. So in that scenario, fiscal package becomes important, and that is where I think the government's fiscal package, although they are talking about a 20 trillion rupees and 10% of GDP, I think the real impact is about 4% of GDP. So it is a reasonably big fiscal package, which indicates to me that if you look at the last column of boxes, that the further profit cut or EPS cut, as we call it in analyst language, is likely to be maybe 5 to 10% in the current fiscal year, and maybe slightly more. So maybe let us assume a 5 to 10% cut in profitability, both fiscal 21 and 22. I think that is the worst case we are looking at right now in terms of profits. So if I go back to this and look at for next year, because this year it is impossible to predict profits. It is beyond a point meaningless to predict profits. But next year, if you look at that 697 EPS of Nifty for 2022, if it comes down to 650, and if we give it a multiple of 16, 17 times, we are looking at a Nifty fair value of 10,000 to 10,500. That's the fair value one should expect, or a target one should expect in the current environment. Now at 9,200, it is neither here nor there, so it's a bit of a no man's land. Can there be a 5-10% correction? I think it's possible. But if the Nifty goes to 8,500, I think it will be a buying zone. It will be a buying zone for you to increase equity allocation from wherever you are today. Because at 8,500, then you are looking at potentially a 15-20% upside over the next 1 year. So it is a game of risk and reward today. And I would want you to realize this very, very clearly, that there is a downside potential of 5 to 10%. But once that downside comes, and if Nifty goes to, let's say, 8,500, you are potentially looking at a 20% return from there on for the next 1 year, irrespective of how the situation pans out in COVID. Because if you look at here, we are anyway looking at a scenario where you are in a live with virus scenario, but you are in a reasonably big fiscal package scenario, which means that the EPS cut of 5 to 10% is possible. But I don't expect that the worst case scenario of FY21-22 a significant EPS cut is possible, which is when you will see probably a larger correction. But as of now, I'm not seeing that as an eventuality. So what are we doing? So sorry, this is another slide I wanted to show before I come to the portfolios. This slide, actually, the black line is what I want you to focus on, the gray line. The black line shows India's valuation premium in percentage over other emerging markets. So if you look at in the last 10 years, the premium has ranged between 30% to 40-50%. And right now, we are in the 20-25% range. So our valuation premium to emerging markets have also come down. And this is very important because, in any market, bottoms, in Indian market especially, bottom will get formed by the FII selling. And the FII selling, you saw huge selling in March. In April, it has come down. My sense is that in May it is continuing, but I think if the valuation stays here, I think the amount of selling will also reduce. And because India's valuation premium to other emerging markets has come down to a level of 20-25%, and if there is a 5% correction, it will be at a level of 20%, which has not happened at all in the last 10-12 years. So clearly there is a big valuation support, and which also points me to the fact that beyond a 5-10% correction, I would be very surprised if FIIs continue to sell. And therefore, that becomes a strong base for the markets where one should be looking at increasing equity allocation. So what are we doing in our portfolios, or what have we done? We at Tata Mutual Fund, we have a philosophy of growth at reasonable price, which has actually helped us significantly. In February, we actually started raising some cash in our portfolio. So we were sitting at 7-8% cash, which we deployed partially in March. And again, today, when the markets have gone up a little bit, we have raised cash. And in a lot of our funds, we are sitting on 8-12% cash. So that's helped us. But beyond cash, what are we doing? So what we did was, we did an analysis in early April. We sat together with our team and looked at sectors where the impact can last longer than FY21, and also looked at sectors where the recovery will be much faster. So where the sectors the impact will be much higher is on the left-hand side column, and the sectors which will recover faster or where the impact will be much lower are on the right-hand side column. So we have moved our portfolios away from discretionary consumption, from retail, SME lending, from capital goods, autos, more towards pharma and healthcare, which I think will benefit and is benefiting from the current situation. Chemicals, agrochem, again, I'll talk about China plus one, but I think it's a huge opportunity for India to start gaining market share in chemical exports, agrochemical exports. In India, telecom had started to do well because the industry structure had changed. But I think it's very clear that the dependence on telecom as an infrastructure sector is probably the most in the new world. Similarly, in insurance, where typically India's penetration of life insurance and general insurance is very low, I think this event will change people's attitude towards how they look at insurance as a product. And lastly, power and gas utilities, where the predictability of earnings is much higher in the current environment. This is some more details on the pharma sector, why we like pharma sector. I think it's as a sectoral fund, if we were to pick one sector fund today, I would say pharma fund looks well placed apart from banking. But banking, you might have a short-term pain, but over the 2 years, banking should give you returns. But pharma, I think from a next 1 to 2 year perspective, is looking good because, pharma has followed a down cycle for too long. For 5 years, pharma has been in a down cycle. Now the balance sheets have improved, the approvals have started coming. I think Indian companies will benefit at the expense of Chinese companies because US-China relationships will come in, will be very helpful to get more market share for pharma. So whichever way you look at it, I think pharma sector looks well poised. So this is just a slide I wanted to show specifically on the sector because the sector has been in focus, and I think it will continue to be in focus. And we have increased our weightage in pharma across all our funds. In fact, we even pre-COVID we had started increasing because we liked it as a sector, and from almost zero weight or negligible weightage in our stocks in our funds, we have now overweight or equal weight kind of positions. I briefly talked about China Plus One. China Plus One as a concept started about 2-3 years back because all the MNC companies wanted to diversify away from China because the cost in China was increasing. And that, coupled with the fact that there was a US-China trade war 1 year back, which is still not settled, and now with COVID situation, I think it will be extremely easy for India to try and get market share away from China, especially in sectors where India has historically done well, like I said, chemicals, pharma. Even in electronics, we are seeing a couple of companies doing very well in getting investments into India, getting people like Samsung, etc., to use them in terms of for their export markets. So I think it's an opportunity. You will probably see. Today and tomorrow there are also going to be more reform announcements by the government. I am expecting that they will announce more and more reforms towards enabling Make in India. I think we should watch out for that. I think it's a huge opportunity, and government is very, very aggressively thinking about how best to take use of this opportunity. So we saw the labor reforms as the first step. You will probably see land and taxation reforms. So I think it's something which is a silver lining from the COVID situation for India. Crude, I need not talk about more. I'm sure you, being where you are, you're reading much more about crude than I am. I think crude is a huge advantage for India because of the current account deficit goes down. In the short term, crude does have an impact on the sovereign wealth fund market activity as well as financial market dislocation, which is what you saw in March, that there was a little bit of uncertainty around the markets and the high yield debt markets because crude went down very sharply. But I think that is something which I think is past, and from now on, I think Indian government is going to benefit from crude oil. We saw that they increase the excise duty, so they are going to get benefit out of the lower crude prices. The last slide on the fiscal package. I think we should not get too excited by the 20 trillion fiscal package and 10% of GDP number, because the real cash outgo is probably likely to be around 4% of GDP and not 10% of GDP. But it is also not bad, because what the Indian government is trying to do is to make sure that they do enough At the same time, they protect their credit rating. And also, they did not come out with the package 1 month back because they wanted to come out with the package just when the lockdown is likely to get removed over the next 15 to 30 days. So I think that is important. Right now, the fiscal deficit impact is only about 1%. But after yesterday's announcement, it's gone up a little bit. I expect that when we finish all the announcements between today and tomorrow, we will end up with a 3 to 4% fiscal impact. Also, very clearly, government yesterday, apart from the fiscal announcement, I think government yesterday announced agri reforms in terms of how they expect farmers to benefit from direct access to the markets. Also, the Essential Commodities Act has been modified. So these are quite revolutionary steps. And one can also say that, like we saw in 1991 when there were huge reforms, when industrial delicensing happened under PV Narasimha Rao government, I think we are seeing somewhat similar movements on the agri side, and I think we will see similar moves on the land and labor side. So already you've seen two state governments, UP and MP, having changed the labor laws to make it easier for companies to set up plants and hire and fire. You will probably see more of that. And you were yesterday, the agri announcement is a step in that direction also. So I think there are silver linings which we have to keep a watch out for. So while we keep an eye on the profit impact in the near term next year, I think India's story is always a 3 to 5 year story. And if the government does enough reforms, I think some of the negativity which we are seeing on the profit cuts will get offset by the reform moves which the government is making. But even if you ignore the profit moves, even if you ignore the reform moves, which will take long time to play out in the near term, I would think that beyond the 5 to 10% kind of downside to profits as well as valuations and Nifty levels, I would think that that would be an excellent time to add into equities. So coming into the funds, very clearly in the current volatility for the next 3 to 6 months, if someone has high allocation to equity, I would recommend that some of that equity allocation should be via balanced advantage fund. And if someone is very risk averse, maybe arbitrage fund. But I think balanced advantage fund, our balanced advantage fund has done very well because we also look at forward P when we allocate equity. So we were at 40% equity allocation till middle of March. We went to 70% in middle of April, and now we are down to 60%. So clearly our model has worked. In the last 3 months, when the market is down about 20, 23, 24%, our BAF balanced advantage fund is down only about 7-8%. So clearly, I would recommend that. In terms of what to buy, if there is a correction of 5 to 10%, clearly I would think that a large and mid cap and a multi cap category is the best category. We have 2 funds. We have 3 funds in this category: a large and mid cap fund, which has done very well; multi cap, which is also the best, almost the best performing fund in that category on a 1 year perspective; and lastly, the equity PE fund, because equity PE fund is a fund which behaves in sync with the economic cycle. And as the economic recovery happens, I think equity P can also give you a good return. So those are the funds I would recommend to add on every correction, because as I said, correction based on numbers, based on hard data, I think if Nifty goes to around 8,500, that will be a good time to keep adding equities. Till that time, I think markets will remain volatile. There's no doubting that. But till that time, there are a category of funds which are managing that volatility well, which is balanced advantage fund. So I would like to end here, and if and open it up for Q&A, because I would. Yeah, that's it from me.
Yeah. Thank you, Mr. Rahul. I would now request all the participants to start putting up your questions on the Q&A option that you have. In the meanwhile, we are just running a short poll, just 2 questions. So I would request you, when the questions are coming, please request you to kindly answer to the poll questions. It will take you hardly 20-30 seconds to do that. Yeah, Mr. Rahul, you were also mentioning as part of your talk that there is a possibility of a correction, and a few questions have also come in that light. Do you think the markets will correct further from these levels? And if so, what sort of corrections do you expect? And for how long do you think we will have this sort of a volatility or a volatile period ahead of us?
See, I think volatility will continue for 3 months at least. I don't see the volatility going away, but one should not be scared of the volatility. In fact, one should be very, very mentally prepared of that volatility, because there are so many things happening at the same time. Whether how smoothly we'll come out of the lockdown in India, what happens in US, what happens in China, what happens to US-China trade relationship. So there are multiple factors, and as I said, it's like a chess game right now. So we have to hold our game. We have to make sure that we have the right amount of offense and defense in this market, and right amount of defense is also required. Which is why I said I think 3 to 4 months of volatility is not abnormal. I would expect that to continue. I think from a correction point of view, as I said, I look at the fair value of the market in terms of Nifty levels at 10,000 to 10,500, which is about 10% higher from here. So is 10% good enough for me to take that risk? I think the FIIs today, when they invest in India, they are thinking like that. Why should I buy for a 10% upside and take so much risk? But if there is a 5-10% correction, and that 10% upside becomes 20% upside, then you will see people taking that risk. And that is the time you should also take more risk. Right now, one should have 50-60% allocation into equities, but if it corrects 10%, I think we should go up to 70-80% allocation. That's the way I would think.
There's another, I mean, from a macroeconomic perspective, there is a lot of liquidity, like you mentioned, at least 4 to 5% of cash liquidity that is going to be injected into the economy. And there is also a sort of a stimulus liquidity of another 5% that is going to be coming into the economy. With this sort of liquidity coming in, how do you think the fiscal deficit, or do they matter at all in terms, do we have to look at those fiscal deficits, current deficits, and what would be your sort of the economic outlook of all this that will happen by doing these sort of, stimulus when, of course, when you're also revenue strained in terms of revenue inflows that will happen this year?
No, very relevant question. In fact, that is why I said when I think the Indian government realizes that. So when they announce a 20 trillion fiscal package, which is 10% of GDP, they are packaging it and they are routing it through different kind of vehicles. The actual impact on the fiscal deficit is not going to be, right now I can see only 2%, but I'm saying with the package announcements today and tomorrow, we'll probably see a 3 to 4% kind of hit on fiscal deficit. So a 3.5% fiscal deficit target for India will probably go to 5.5-6%, because with crude prices coming down, government is also raising resources by increasing the excise duty on petrol and diesel, on gasoline and diesel. So they are also raising more revenues. At the same time, it is a challenge. There's no doubt that if you ask me whether this 5.5-6% fiscal deficit, how confident I am that it will not get exceeded, or how confident even the finance minister would be, she will be very less confident. I would also be very less confident, because this slowdown is quite severe, and the fiscal deficit can go to 7-8%. But the good part is that RBI has a lot of liquidity which it can give to support the bond yields and to support the borrowing program of the government. So I don't expect that the government borrowing program will destabilize the market, if that is the question we are asking.
Yeah.
Because I think monetary stimulus also will happen apart from the fiscal stimulus.
Thank you, sir. I mean, this is a question that we get in all our webinars. I will just join these two questions together. One is where do you see the rupee in terms of whether it will appreciate or depreciate from these levels? Where do you see the rupee going forward? And your thoughts in terms of gold as an asset class as of because gold has been one of the best performing assets this year as well. So this is a question that we get in all our webinars. So your thoughts on these two, please.
So on INR, I think I'm not an expert on INR, but I look at only two variables. One is the crude oil and gold imports. And today both are down. Both are down to much lower levels than what it was earlier. So our current account deficit from being 2% of GDP will probably be zero in this scenario, or maybe 0.5% of GDP. Now, when current account deficit comes down to 0.5% of GDP, which is historically at a low level, then even if you get FII outflows and lower remittances from say Middle East or from US, rupee can absorb that hit because your current account deficit is much lower. So my view is that we have probably seen the worst of the FII selling in March, the worst, where you saw $5-6 billion of sales. Now the sale figures of FII are in the $1 to $2 billion range. So you've seen the worst in terms of FII selling getting absorbed and rupee not depreciating too much. So I would not think that that's a risk. Maybe there is a momentary or maybe risk, as in I don't see rupee depreciating very sharply. The only risk I see is that if there is a rating downgrade and if the slowdown kind of goes on for instead of 3 months, 6 months, and if there is a rating downgrade, then there could be a knee-jerk reaction. But I would think that otherwise it will be a fairly steady depreciation. I don't see rupee appreciating, of course, but I think the steady depreciation which has been happening will continue. As far as gold is concerned, I think gold is a good thing to have in your portfolios. In fact, we have a fund which we launched 3 months back called Multi-Asset Fund. And in Multi-Asset Opportunities Fund, we have the flexibility to buy up to 10% gold, and we are doing that. So I think gold is a good addition to the portfolio to the extent of 10-15%, because there is so much uncertainty globally on the slowdown, and because the way the global situation will change after this in terms of the US-China dynamics. There is a US election end of the year. So globally, there are risks which will keep things very volatile, and clearly we are going into a scenario where you will see 1 or 2 quarters of negative GDP growth rate, and typically that is a time when gold does well. So like I was saying, in this period of 3 months when there is going to be volatility, and which is when I was recommending funds like Balanced Advantage Fund, I think you could also look at funds which have allocation to gold, or you could look at gold ETFs. So I would personally be looking at gold more favorably.
Thank you. There are a lot of questions that are coming in pertaining to sectors that one should be looking at, and a few of them are concerned especially on the banking sector in terms of how will they perform in the coming quarters and years, especially the PSU banks. And do you think there would be a sort of an NPA surge happening across the banking sector, and how would this sector, and as a continuation to that question, in terms of how the NBFCs are also going to perform in the coming few quarters and years?
So very good question, because 40% of Nifty, almost 35-40% of the Nifty or Sensex is banking and financial services. We had a very high weightage on banking financial services in February, but we realized that there are two things happening with banks. One, the growth is going to slow down. A lot of growth was coming from consumer credit, SME credit. In the last 2 to 3 years, a lot of growth has not come from corporates, but from SME and retail category. So we could see that companies which are growing at 20 to 30% or even 15 to 20% will see a sharp slowdown. And that has already happened, and that will continue to happen over the next 1 year. So one, growth slows down. Secondly, when growth slows down and when the economy is under stress, you will see NPLs going up. But Interestingly, the last bad loan or bad NPLs were because of big corporates. This time, it is likely that the bad loan cycle is going to be because of the smaller loans, the SME loans and the retail loans, unsecured loans, credit cards, and so on. So we have to identify banks which are more heavy in those segments and reduce our weightage or move out of those banks, which is what we have done. So we cannot say that the entire sector will do badly or all the companies will do badly. We have to identify banks which have grown very fast in the retail and SME segment and try and reduce weightage there. That is number one. Number two, within banking and financial services also, there are parts which are going to actually do very well. For example, insurance, general insurance or life insurance as a segment which is underpenetrated in India and was growing well. This kind of a event increases the demand for both general insurance and life insurance. And I think that's a huge segment. Um, we've got some really good companies listed. So we don't have to be in banks. When we move out money from banks, we can move into insurance, and that's something which I think is an opportunity.
I think the sector-specific questions continue to flow. So I would like to consolidate all into one simple question, asking you what, in your view, are going to be how would you rank these sectors? Which are the best sectors that you would look at? Which are the sectors that one should avoid at this point of time? And which are sectors that are sort of neutral? So that if you can mention the top three sectors that one should invest in, avoid, or be neutral about.
So I think, as I mentioned, the sectors when I showed that slide, it was very clear in that slide, but I'll repeat it that the sectors which I think one has to avoid is the banks or financial institutions which are into lending into retail and SME side. We have to look at discretionary consumption, anything which is dependent on human activity or high ticket discretionary items will suffer. Similarly, anything to do with travel, hotels, aviation is definitely going to suffer. I think we are not going to see any recovery for the next 2 years in those segments. Those are the sectors to avoid. The sectors to get in, as I said, are primarily three. I would see healthcare and pharma, where there is an opportunity. Chemicals, where again there is a big opportunity for India to take market share from China, and insurance.
Thank you. I now move to your next segment. A lot of people are now asking in terms of how should portfolio allocation be done at this point of time, in terms of if you look at an investor today, to what extent, how should he diversify his portfolio in terms of an equity or a debt or any other asset class that should be forming part of the portfolio?
So I think 50% should be equity, like I said, at the current valuation. But if the valuation comes down to 10 by 10, 15 per 10% or so, I think that 50% should go to 70%. I think you could have 15, 20% in arbitrage funds or liquid funds because that is the opportunity. That is a liquid money I would park to make use of any correction when it happens. I would have another 15, 20% in a PSU and banking PSU debt fund or a banking debt fund where you're not taking any credit risk given what has happened in the market recently. And the last 10% I would keep it in gold. So it will be 50, 20, 20, 10. And if the market corrects by 10% odd, then that 50% equity allocation can go towards 70% by reducing liquid and arbitrage.
Great. I think another questions that has been asked about is on the real estate sector, in terms of how do you see both the commercial and the residential side of the sector performing in the near term?
I think commercial side has huge challenges because obviously with companies, even if the companies go back to work, they might decide that they don't need 25% of the space. And because at least 25% of the people might be working on a rotation basis from home, even in the long-term basis. So this will put a huge pressure, I think, on the rentals, the commercial rentals. Also, commercial rentals, there are a lot of malls and multiplexes where the demand will come down. So I think all the multiplexes and malls will, multiplexes and the big retailers would ask for a discount from the commercial real estate in terms of rental. So I think commercial real estate will get very challenging. I think residential is difficult to say because over the last 10 years prices have been declining or prices have not gone up. So adjusted for inflation, prices have already corrected. So if you exclude some smaller markets like Bombay, where prices are still very high, I think in Bombay prices will correct because demand is coming down and there is a lot of supply. I think in a lot of other markets, the inventory had come down, and I think there is a pent up demand for houses. So I am not very worried on residential real estate doing very badly in terms of the pricing or in terms of the price correction, except in obviously markets like Bombay.
Great. We are also seeing a lot of news about investments moving out of China and to flow into some of the economies in Southeast Asia, and India is also likely to be one of the beneficiaries on that. Do you think that this is going to happen, and to what extent, in what sectors, or to what extent do you think sort of investment flows will happen from China? Sorry, industries moving out of China.
No, it will definitely happen. It is happening. In fact, I know personally, I know a friend who heads Mahindra World City. So Mahindras are building up these small pockets of land, developing land, and inviting investment. So there'll have to be a private public partnership or a private government partnership. And he was telling me that in the last 3 months, when COVID was happening, they have signed 8 industries to come to India in Jaipur and Chennai. So this is happening. It is not just wishful thinking. This is first-hand information I am telling you, because I think there is going to be a lot of pressure on the US corporates specifically, who are only dependent on China, to look at options outside China. And I think it's a huge opportunity, and I think it's happening. The sectors, as I said, will be mostly in electronic manufacturing, autos, textiles, and chemicals and pharma.
Mr. Rahul, can you also share some thoughts about your Tata Ethical Fund in terms of how that fund is positioned in terms of this market scenario?
Yeah, so Tata Ethical Fund, actually, interestingly, I forgot to mention it. I should have mentioned it earlier. In this environment, it is looking quite good because it does not have it obviously is not allowed to hold any financial stocks or banking stocks. So roughly 60% of the portfolio is between IT services, pharma, and consumer. Another 10% is in oil and gas utilities. And we are sitting on 10% cash. So when there is a correction, 11% cash. So when there is a correction, we will identify opportunities in these sectors. So in the current environment, when there is so much uncertainty on banking and financial services, I think this fund is quite well positioned. And in India, we get great companies to invest in consumption and IT services, very high quality companies, which return cash to shareholders, high dividend yield. So I think it's a very in the current environment when there is so much uncertainty, I think ethical fund by design is is going to be much more stable than our other funds, even if there is volatility.
Thank you, Mr. Rahul, for your wonderful session. I think it was quite insightful to understand the economic impact that the stimulus is going to bring in, and see in terms of what the road for the future lies ahead of us. I thank you very much for sparing your valuable time to address our clients. And before we sign off, I would now request our director, Mr. K.V. Shamsuddin, to propose a formal vote of thanks. Over to Mr. Shamsuddin.
Mr. Rahul and our dear participants, very happy to see all of you, nearly 400 people today morning. and it was very useful webinar, especially at time we had a lot of stimulus from the government of India, and yesterday and today, tomorrow also we are expecting something. Maybe some of the figures we had seen yesterday and all, it was much higher than the budget allocations. So we are seeing lot of expectation from the market, and Mr. Rahul has given a lot of ideas to investors to take a decision. This is very useful information we received, as you mentioned, healthcare and pharma, chemical and insurance and all. It is a very good advice you had given to us, and all the investors will make use of this opportunity. Last a few weeks we are conducting similar webinars, and many people got a benefit out of that. Many people, those who are very long-term investors, they moved to short-term investor and making money from the market. So I hope all of our investors had lot of benefit in this webinar. I express our sincere thanks to all the attendees as well as Mr. Rahul for giving an excellent presentation for our investors. Thank you.
Thank you,
Mr.
Mr. Rahul.
Shamsuddin.
Thank you very much.
Thank you, Mr. Krishnan. Thank you, everyone. Thank you. It was a pleasure.
Thank you, Rohan. Thank you.
Thank you.
In the last 25 years, the returns on various financial asset classes like bank deposit, gold, and real estate have multiplied several times. But there are a few select investments in the Indian capital markets that have had the potential to appreciate exponentially over 100 times. If you had known this at the right time, you would have taken the right investment decision, which is precisely why you need an expert's validated advice when it comes to investing. Welcome to Barjeel, one of the few SCA-approved financial intermediaries in UAE. We are wealth builders, guiding customers since 2001. We have serviced over thousands of them till date, and today we cater to large segments across investor groups. This speaks about our enormous goodwill and their undiluted trust. And we have earned that trust by telling, not selling. We educate you on the investment opportunities that are ideal for you. We then help you make an informed decision, impartial and unbiased, keeping your long-term goals in mind. And with us, everything is long-term, be it commitment, relationships or success. We offer comprehensive insights across a wide range of products through a holistic approach. We ask you the most important questions, the answers to which will help you focus on your investment objectives. For example, you work for over 30 years. Are you saving enough for the next 30 years? For life goals like children's education, your daughter's wedding, or your retirement. Think about it. You work hard to earn your money. Does your money work hard enough for you? Barjeel, let's build your future. Come, let's talk.